In today's video, we're going to be talking about the Asian range strategy and, more importantly, how you can actually trade it the right way. Now, a lot of people think trading the Asian range is very simple. They think you just buy below the Asian low and sell above the Asian high. And that exact mindset is the reason why so many traders keep losing with this strategy. So in this video, I'm going to break everything down properly. I'll cover everything you need to understand so you're not just trading blindly. First, we're going to talk about what the Asian session actually is and the specific time I personally use for it. Then we'll look at why Asian session highs and lows matter so much in the market. And finally, I'll show you how to trade the Asian range in alignment with your higher time frame bias, because this is where most traders get it wrong. Most people trade the Asian range without any bias at all, and that usually leads to unnecessary losses. Now let's start with the basics. The Asian session is generally the lowest volatility session of the trading day. And this is especially true for pairs like Euro-USD, GBP-USD, GBP-JPY, and most non-Asian related pairs. Because volatility is low during this session, price often doesn't trend aggressively. Instead, it tends to consolidate, and that consolidation is what usually forms the Asian range. Now, does the Asian session always range? No. Some days it can trend. But here's the key thing. You don't actually need it to range for this strategy to work. Whether the Asian session ranges or trends, the highs and the lows always matter. And the reason they matter is because of liquidity. Retail traders love placing their stop losses above highs and below lows. So traders active during the Asian session usually place their stops above the Asian high and below the Asian low. On top of that, breakout traders, especially those trading the London breakout, also place their buy stops above the Asian high and their sell stops below the Asian low. So what does that tell us? It tells us there is a huge concentration of liquidity sitting right above the Asian high and right below the Asian low. And price doesn't move randomly. Price is constantly seeking liquidity. This is exactly why those levels matter. Now, this brings us to the main concept we're going to focus on in this video, and that is the Asian session sweep. There are two types of Asian session sweeps you need to understand. The first one is the Asian high sweep. An Asian high sweep happens when price moves above the Asian session high, usually at the beginning of the London session. At that point, price forms what becomes the high of the day after taking out liquidity resting above the Asian high, and then reverses direction, continuing to push to the downside. This move traps breakout buyers who are expecting continuation to the upside, while institutions use that liquidity to position themselves in the opposite direction. The second type is the Asian low sweep. An Asian low sweep happens when price moves below the Asian session low, again typically during the early part of the London session. Price displaces below the Asian low, forms what often becomes a low of the day, takes out sell-side liquidity, and then reverses, continuing to push to the upside. In this case, breakout sellers get trapped, stop losses get taken, and price moves aggressively in the opposite direction. So the key thing to understand here is this. The goal of the Asian session sweep is not continuation, it's liquidity. Once that liquidity has been taken, that's where we stop chasing price and start looking for high probability setups, especially when the sweep aligns with our higher time frame bias. And that's exactly what we're going to break down next. How to trade these Asian session sweeps properly step by step without guessing and without gambling. When it comes to bias, a lot of traders use different methods to determine it. And that's completely fine because bias is extremely important. To determine your bias, you can use market structure. You can also use higher time frame highs and lows because those levels are very important, especially when price sweeps above a higher time frame high or sweeps below a higher time frame low. Another powerful concept you can use is internal range liquidity to external range liquidity. Every single one of these concepts has already been explained in detail on my page, so make sure you go back and check them out after this video. These are all solid tools you can use to determine your daily bias. Now the next question is, how do we align our bias with the Asian session sweep? Aligning your bias with the Asian session sweep is actually very simple. All you need to do is go to your higher time frame and ask yourself one question. Am I looking for bullishness or bearishness today? This is very important because your expectation for the day should never be based on guesswork. It should be based on higher time frame analysis. So if your higher time frame analysis tells you that you should be bullish for the day, then when you look at the Asian session, what you want to see is price sweeping the Asian session low. Once price sweeps the Asian session low, that is when you start looking for buy opportunities because that sweep is very likely to become the low of the day. On the other hand, if your bias for the day is bearish and price sweeps the Asian session high, then that is exactly what you want to see. But if you're bearish and price sweeps the Asian session low instead, you have no business trading that move because it becomes a low probability setup for your bias. Now let's look at an example using a bearish bias. From the higher time frame, we can see that price has been sweeping liquidity. Not only that, price also swept the previous candle's high and then closed back below it. That tells us we should be expecting bearish continuation into the next day. So now we know we are bearish. When we drop down to the lower time frame, and I personally prefer using the 15-minute time frame to mark the Asian session highs and lows. But because we are bearish, we are not interested in price taking out the Asian session low. What we are interested in is price taking out the Asian session high. So we wait for price to sweep the Asian session high. That sweep becomes our London manipulation, and in many cases, it also becomes a potential high of the day. Once price takes out the Asian session high and starts reversing to the downside, we can now begin framing our sell trades and targeting the Asian session low. Now let's look at the same concept using a bullish bias. From the higher time frame, we can see that price formed an overlapping high, a swing high that also overlaps with a fair value gap. Not only that, price swept the previous candle's low and closed back above it, which tells us we should be expecting bullishness the next day. So now our bias is bullish. We mark out the Asian session high and low, and this time we wait for price to take out the Asian session low. Once that Asian session low is swept, we expect a reversal to the upside. That sweep now becomes our London manipulation and our potential low of the day. From there, we can start framing our buy trades in alignment with our bias. Now let's head over to the chart so I can show you some live examples of how this actually plays out in the real market. Now I'm going to show you two examples. First, a bullish example and then a bearish example. Let's start with the bullish one. The very first thing we should do is to go to the higher time frame to understand the bias for the day. In this case, we're looking at the daily chart, and if we look closely, we can see that price has been trending to the upside for several days. Because of this, we would be expecting the market to take out the previous day's high. That previous day high becomes our draw on liquidity. And since that is our draw on liquidity, It tells us that we should be looking for bullish setups today. So now that I have my bias, we can drop down to the lower time frame, which in this case is the 15-minute chart. On the 15-minute chart, we mark out the Asian session high and the Asian session low. Since we are bullish, we should not be interested in selling. What we want to see is price taking out the Asian session low. However, after price takes out the Asian session low, we don't enter immediately. We wait for price to show me intention. We want to see confirmation that this move below the Asian low was a manipulation and that price is now ready to move to the upside with strength. And that is exactly what we get here. Price sweeps the Asian session low and then impulsively pushes to the upside. That impulsive move leaves behind a breaker block. Price then retraces back into that breaker block and continues pushing higher. Now let's move on to a bearish example. In this case, when we go to the higher time frame, we can see that price is bearish. Price is trading inside a bearish fair value gap, and we are expecting that fair value gap to hold. Because of that, we should start anticipating downside momentum for the day. With this bearish bias in mind, we can now drop down to the 15-minute time frame. Once again, we mark out the Asian session high and the Asian session low. Since we are bearish, we are not interested in buying. What we want to see is price taking out the Asian session high. And that is exactly what happens here. Price takes out the Asian session high, and shortly after that, it reverses to the downside. That reversal leaves behind a fair value gap. That fair value gap gives us a clear area to frame our trade. From there, price continues moving lower and targets the Asian session low, which is exactly what we expected based on our bias. So this is how to accurately trade the Asian session sweep. These are just two examples out of thousands of examples you can find on the charts. But we're going to stop here for today. If you found this video helpful, give it a thumbs up and subscribe. I'll see you in the next one.